Hi everyone, welcome to mykayaplus YouTube channel. My name is JP. So you are going to watch a previously private video made for our Premium Club members. So as mykayaplus slowly renew and update our Premium Club services, we have decided to make this private video into a free content for your viewing and learning pleasure. So we hope that you enjoy this lesson and this video. Today's sharing is just, as always, a disclaimer does not constitute to any buy, sell, or hold decision for whatever companies that we might be using as examples. So if you really like the companies, do your due diligence and study further before entering making any related decision. So of course, this is always our ethos, our principle. When you actually log on to your trading platform, it's not just the company names and the prices, and you just do a little bit of clicking and that's it. But you really have to know that in actual, in real life scenario, these are companies that either are providing you a product or services, or even uh, giving you different kinds of benefits and helping you make your life easier in whatever things that they are doing lah. Right. So of course, whenever you come across a good company or not so good company, in your head, you must always be you must go through a certain kind of procedure. You must really dig deeper inside your thinking and thoughts. Why is this company good and why is this company not so good? So in a way, it's a bit like playing chess. You need to see things from a bigger picture and then plan your steps and or even plan what to analyze deeper, right? So Chun Bing, are you familiar with chess and inside your head, every time you come across, say, for example, a company that you think is interesting to you, do you actually think, okay, what's actually good about this company and also what is not so good about this company? Then you argue inside your head to make a final judgment.
Yeah, that's why what I usually do is I will go through the competitor.
Yep.
Hopefully they are. If there isn't any competitor, then probably the stock will be very expensive because they are like the people that monopolize the business. So everything come with some meaning behind, and then this is the thing that can help you to judge whether when to buy and when to sell. Of course, at the end of the year, at the end of the things you wanted to make monies, so that's why need to be clear on your target. And if you are buying because you believing this kind of industry will be having a lot of potential in the future, then maybe you just need to be having the faith on it. It'll take time, take a few quarters before you realize the stuff. But if you are planning to ride on certain short-term rush, for example, during the pandemics or whatnot, then glove, medicals related industry, then you need to know when you should exit. So, but if you can't really answer, then you might need to take a step back already. Else, you need to spend a lot of time monitoring the markets, and it's as good as gamble lah. So
Yep.
sometimes it become uh playing against your luck rather than playing against your analysis. So it's something that we don't want to end up going to be like this lah. Investment is all about something that you make a decision based on calculated risk lah. It's not
Yep.
really based on luck or based on whatever mega trend. So don't treat this like a gamble lah. It's not good.
Yep. So I agree with you. I think whenever you not only when you look into a company, even though if you look at a company, you think this company might be going through some positive up trend in the short term, you have to always remember that it's short term, right? And price can go up very fast in the short term. It also might come down or more likely to come down faster also in the short term as well. So your game plan has to be set before you actually buy. As you said just now, if it's a company that's just benefiting from a certain kind of catalyst that is short term, then yes, your game plan was be enter it before it goes up, and before it actually comes down. You must set a kind of limit that, okay, I'm happy with this kind of earnings really, because it's a short term game plan. You already plan to make it a short term trade. Whereas if you are more comfortable in certain companies for a longer term of horizon, then you also have to approach it differently. You cannot expect the company to go up 20% or 30% just within 1 to 2 months, because the game plan doesn't really pan out that way. So in some ways, you have to go through all of this thinking, or this decision making before you actually buy and sell a company. So in a way, it's really much like chess. You always need to plan ahead. Where are the opportunities? What can actually go wrong if one piece actually goes the wrong way or goes the right way? So we must always ensure that no pieces are left hanging, so that one piece gets attacked, and then the other piece can also counter attack. So all of this, it's very like playing chess. You always have to ensure that even though you want to win the game, you cannot sacrifice the most important pieces on your chessboard. So whenever we play or whenever we invest, we always want to invest for gains, be it dividends or be it capital gains, right? We do not ever envision ourselves buying into a stock just because you want to lose money, because that's impossible, right? So the theory behind investing is pretty much like playing chess, and the end results is also pretty much the same. Both of us invest or play to win the game, and we have to begin with the end in mind, which is we want to win the game. So if you really, really want to win the game, and not just to eat or to take away the rook, the knights of the opponent, but rather really to checkmate your opponent so that you really win the game, right? So you need to know what are the reasons that can make you lose whenever you enter or buy a certain kind of company. You always need to know what are the reasons behind. No company in this world is perfect. They might be very, very strong in certain segments. They can be a monopoly. They can be having a very bright and visionary leader. They also can be running a business with very, very high profit margin, right? So, but that doesn't mean that they are invulnerable. Like, doesn't mean that they will be always earning money 10, 20, 30 years down the road. It's just so happen at the current phase of time, there's no strong competitor to come and disrupt them, right, Junbei? So, Junbei, what are the kinds of company that people from first glance think that, oh, it's a very strong company, it's a very good company, there isn't really much risk to actually think about that company, or that can impact the company. But if you think deeper, you will realize that, this company actually have this kind of weakness, this company actually can face this kind of disruption. So what are the few, one or two examples that you can come in mind, if you have it?
Yeah, so for example, I think earlier of the year, people was having a very strong assumption that the recovery of the economy will be coming soon, due to the number drop to actually 1,000 plus, I think early of the year. Then people start to actually put a focus into recovery stocks. Just as if they put in the money, I think 1 week later, 1 month later, then magically the whole economy will be rebounds. So it might not be true. So that's why you cannot just purely banging on the mega trend. It might happen, it might not happen. So that's why on top of it, you need to know what is the company, what are they doing, are they able to survive through this wave. So some of the example is like people are throwing money into Gentings, for example. Nothing right or wrong. Asia as well. It's just whether you can uphold the paper loss for a few months, or maybe up to 1 year. You don't know, especially for stock like Asia. you just need to understand they are positioning themselves as the low cost F flight providers. But then think of it when everything come back due to the all the SOP that imply, it might not be cheap anymore. Then every airline is dying. Then people will just throw promo. So the unfair advantage they are having might not be true anymore when COVID closer to an end. So that's why when you invest into it, are you believing into Tony Fernandez game plan to do all the digital expansion, for example, the super app or the delivery, or you are just purely thinking it will be back because COVID is gone? Then it's quite dangerous because you're just thinking from one angle, and a lot of people are doing the same thing like you. That's why you see the price movement, but at the end, it might not happen, and you will just lose the money like majority of the retail investor.
Yep. Very, very good example. And just to bring everyone back to the month of September last year. So this is an actual conversation within our WhatsApp group. So we do have a WhatsApp group within our peers, not for Premium Club, but within a peer of friends. And you can see here the message partially started off with someone within the group asking why cut, means why take loss, or why cut away the company if it's currently at a loss if you're holding at a higher price. Now next quarterly results PE will make the overall PE below the history average. So we hold tight. So hold on to this company because the upcoming earnings of the company will actually boost the earnings per share, and supposedly share price will tag along with the company's earning profile as well. So I actually replied with one what if question there, which is I asked them what if there is a PE contraction. So we'll go deeper. What is a PE contraction? I was actually putting up some valid reasons that it's not always so foolproof and straightforward that the company share price will diligently and disciplinedly follow the earnings potential of a company. And I guess, if I remember correctly, this was actually referring back to one of the glove companies listed on the Malaysia Stock Exchange. So, and he was asking me, replying me, PE contraction means PE go low or E go lower. So on and off, what happens when a PE contraction really happens is that during a certain period, even though the earnings may be increasing, but the share price will fall down. Hence, you will have a lower PE. Or if the earnings fall, but the share price fall even faster, so you will also have a tendency to see PE contraction as well. And this is why it is very, very dangerous just to solely find stocks based on a low PE number. Just because a company is having a PE multiple of 1, 2, 3, or even 4, you are saying that, oh, this company is cheap, because the earnings of the company might have been dropping throughout the past few years. And because of the negative sentiment surrounding the company, the price dropped even further, and hence you get a very fake kind of cheap PE that might entice you to buy into a company, right? So to really show you guys through the formula, so if the share price goes down, even though the earnings per share goes up, your PE will actually go down. So that is your kind of example of a PE contraction. Or it could be the earnings per share is been dropping all over the years, but the share price actually dropped faster, hence you get a lower PE as well. So PE contraction is one of the reasons that can actually distort and throw you off guard, even though the company might be reporting a very, very good earnings, or even having very good prospects of earnings in the coming quarters. And there you have it. So back then, I think in the month of September, growth stock prices were still at really, really high levels, but I think it's already coming down. That's why they were asking the future earnings is going to actually make the company very, very undervalued, right? So this was actually taken in the 27th of April, and that time Top Glove is only trading at a PE multiple of 6.88. Historically, this is a company that is always trading at around 35 to 40 times PE, but as of current scenario, current day, there is a little bit of PE contraction there, hence giving you the kind of sentiment that, oh, it's already cheap, you should buy or you should buy more. And I guess pretty much a lot of people were stuck at the high levels because they were expecting the share price to diligently follow the earnings potential and prospect of the company. So this is a real thing, and you really need to take note of it. It only happens when the share price goes up too fast, like what happened last year. So when a lot of people are actually jumping into the bandwagon, and you also have equal amounts of sentiments where the pandemic could be over with the presence of a vaccine, that is where the market goes into a chaotic ride. It goes up, it goes up vigorously. It also comes down vigorously as well. So another question, some of you might be saying that, well, COVID is actually coming again. The fourth or fifth wave of COVID is actually re-emerging, especially true in countries like India, who are really, really badly impacted. But yeah, I think Malaysia is not looking that well either, right, Chun Beng?
So there's a lot of assumption need to make if you wanted to jump into glove stock, or maybe we don't talk about glove stock. We talk about something that everyone is discussing. So this kind of thing usually it tend to be very volatile. It can be overvalued or oversell due to some news. So this is not going to just happen one time to glove related stock. It will happen again and again and again in the coming year. Just different team, different type of stocks, and so on. That's why ultimately when you jump into this, you just need to know you need to set your target upfront. Imagine you can hit about don't know how many percent gain, then you just left. You don't, because it seems like it's still promising, then you just keep it there. Then it's hard. It may end up you enter it at a very low price. For example, you take glove stock as an example. You enter at about 4, then it go up into 10. Then because of so many news around you, and you didn't set your game plan upfront, you just hold on it. Eventually, it fall down to 4 or even lesser than 4. Then what is the meaning of you? You are quite smart, able to jump into this before this thing get boom, but then you didn't manage to get anything out of it because you just keep on holding on it. So that's why for me, you need to set the target price up front, and what is your main assumption that take along with you. For example, imagine pandemic come in, the glove demand will be there. It's true, but when the glove demand is there, other people also will start to increase their capacities. It's just how fast those guys can catch up. So maybe you think for this guy to actually buy all the equipment and then set it up, it maybe need 1 to 2 quarters. So it's quite logical that within the next quarter you just straight away grab profits. Then you just don't get affected by it anymore, even though it seems like you didn't maximize your gain. You need to remember ultimately what is the actual realized gain is the most important. Else it can give you 500% gain. Then now you didn't do anything, you hope to go higher, you think you can hit 1000%, and go back to maybe 10% or even less than 10%. So what is the point? So that's why you need to have your own assumption upfront. Might be wrong or might be right, but then you need to have it upfront. Else it's very hard for you to make any decision, sell call when the time is there.
Yeah, I kind of agree with you on this one. Later we also touch on probably why that even though in the future when growth stock company prices will come down, I will also not buy or invest into a glove companies. Later we'll talk more about that because I also have a what if kind of question that prevents me to invest in a glove company. So of course, maybe most of you have seen that the prices have been coming down. I think before even the surge of COVID cases in Malaysia, a lot of people are saying that the price is low enough to actually reconsider glove stocks. Yes, I would say later we also do a little bit deeper dive also. There's also an upcoming WhatsApp print screen between me and my mom asking me also about glove stock. But just to bring you guys back, a lot of people are saying that if COVID cases were to become serious and more serious, growth stocks will go up because it's a very normal, straightforward kind of assumption. Even if you don't even go into the deeper numbers of and details, it's a very straightforward assumption, right? But I also want to throw in a what if kind of questions. If what if there's always going to be a PE contraction for growth stocks, at least for the time being, because we are still stuck in a pandemic and it's still a very volatile counter. It has been going up and down quite vigorously. So what if there's always going to be a PE contraction because a lot of people are stuck buying at a high price, and when the price goes up more and more, it actually gives incentive for those people who have stuck, who have their capital stuck up here to actually free up the capital. So there'll be a bit of selling pressure as the price eventually goes up because people have been stuck with what 40%, 50% capital losses if they bought it at the top. So what if this kind of continuous selling pressure will also ensure that this kind of P contraction exists at least for the time being, and it prevents the top growth from achieving high share price, right? So this is also one aspect that you also have to think about. This has nothing to do with the company's figures, numbers, financing, cash flow, but more of the psychology of the mass public, because at the end of the day, you are betting or you are taking a position against many people outside in the investing world, and you have to ensure that you are the one that's actually earning or profiting whenever you buy into a company. So food for thought to think about whether this PE contraction will continue to play a significant headache for glove stock prices to go up higher. Right. Of course, if you were to go deeper more to the fundamental part of it, these are some kind of questions that you should ask yourself. Of course, no one can argue that growth stocks have been reporting good results. In fact, the results keep getting better and better. But as you guys must know, what they are reporting now is just the reflection of what has actually happened 3 months ago, which is 1 quarter ago, right? So, of course, during the past few months where things were very rosy for glove companies, be it in terms of the raw material prices, in terms of the forex, in terms of the demand, everything was all aligned in place for glove companies to report very good results. But the keyword here is what if in the future, or in fact, most likely in the near term, the stars do not align for a sustainable bumper results. So this was an article also I wrote even before the PE contraction message. It was cited the risks to note before jumping onto the growth mania. That was the period of time where growth companies were seeing their share price going up like mad. I actually highlighted 5 points to actually just bring everyone back to the basics and on a neutral ground. What are the things that you actually need to think of before you actually confidently say that growth stocks prices will actually go up higher? So we all know that these kinds of earnings and volumes that the glove companies are reporting are all pandemic driven, right? Because of the pandemic, everyone is actually using more and more gloves. So the volume is actually driving the pandemic demand up. So, but the question is, will the pandemic be around us forever?
will this kind of levels of demand be permanent or not? So if it's not permanent, sooner or later, one day, the volume will drop. And when that volume drops, are you fast enough to actually take profit? Or you will be the one looking at the so-called share price drop, then only you react when it's too late. So these are the kinds of what if questions that came to my mind when I was crafting this article. Of course, there are also other factors like, of course, we talk about how glove companies are selling their gloves at a higher price, but when volume were to normalize back to normal, can they still sell gloves expensively? So this is another volume play and also a pandemic play that can actually go away when things return to normal. Of course, forex also plays an important element in the earnings of a glove company. So will therefore forever always be a very good foreign exchange rate for Top Glove to report a good net profit because of weakening ringgit. And of course, being a manufacturer, they also rely heavily on the raw materials. Therefore, raw materials will always be at a cheaper price for them to actually eke out their better margins as well, right? Of course, last but not least, will Malaysia forever be the country that everyone is going to depend on for gloves, right? We have been supplying almost 60+% of the gloves used worldwide. But now that we know that the pandemic can actually make everyone so vulnerable, will the other countries also set up their glove factories as well in their respective countries? So these are the kind of questions that you need to ask yourself, think very, very deep about it, then only make a decision on whether if you want to buy into a glove company shares, what kind of game plan would it be? Would it be a short-term one, middle-term one, or a long-term game plan? So these are the kind of questions that always need to come into your mind, because they will always tell you these are the good things that has actually improved a company's earnings. So you have to ask yourself, will these good factors be permanent or not? And if not, when will it stop? So all of these have to come into mind. And of course, the one what if that really no one expected, if you rewind the time back to 1 year ago, that it is possible to come out with a working vaccine just within 1 year's time, right? I think we just did it maybe a little bit more after 1 year. I think we did it 1 year, within 1.5 years, we actually came out with a COVID vaccine. No, I think actually by end of last year, the COVID vaccine actually was ready. So yeah, we did it within 1 year. That was actually one of the what ifs. If you actually ask this question, why we actually came out with a vaccine within 1 year's time, just during last year, April, if you were to shout this question out, people would have laughed you off. And fast forward 1 year, we actually see this kind of scenario happening, and that potentially explains why glove stocks has came down, because everyone was very, very hopeful for every reopening. So Chun Bing, did you expect the vaccine to actually come out so quickly?
I didn't make any projection, but I'm assuming with this kind of thing going out for everywhere, even though it might not be super effective, then the government will just take it and roll it out. And I think this is what is happening right now. Even though, for example, Pfizer's vaccine is claimed to having 95% effective rate, but they are expensive and so on. So the government have left with no choice but to actually take on other type of vaccines, which might be less effective, to just roll it out. Else the economy might not be rolling anymore. Then people will suffer from more social related issue rather than suffering from COVID. For example, having job employment issue, having different mental health issue because need to work from home for very, very long. So this is the real thing that's happening, and putting the government have no choice but to roll it out as fast as possible. So this thing will definitely come. And this, on the other hand, is the catalyst, go back to all the recovery stock that I mentioned before. But then is this thing when it come, will straight away shut down glove related stock? It will not. Will straight away bring up the business of all the recovery stock immediately? It also won't. So you take some time to buffer the whole thing out, and that's why you need to know what is the thing that you're buying into. If you're buying into recovery, then you just need to be patient. It's not going to be 1 year, 2 years. Imagine you buy into Asia. I will assume safely assume if for you to go back to normal travel situation like last time, it maybe take more than 5 years. But people start to fly maybe can be end of this year or mid of next year. But do you think a lot of people will just go off to travel like last time? It will not. It will take very, very long. So this is all the things that you need to take into consideration. But of course, if you talk about recovery stock, then bank is another option. People need it to run business. People need it to get student loans and all those stuff. So it will still be there. So the recovery period will be much, much shorter if compared to airline. So this some few things to take note before you jump into all this so-called very obvious trend that everyone can understand. If everyone can understand, then it won't be having a lot of so many retail investors that's losing money.
Yep.
It got to be people that's earning, that it got to be a lot of people that's also losing as well.
Yeah. So yeah. So I think one key reason or one key mistake that why people tend to lose money is that it always revolves around PE, right? Because as we talked about just now, just because a PE contraction happens, the earnings of a company is going downhill, but the share price is actually going faster, and it just gives a false sense of image that the company is cheap. That is one part of it. And another part of it, we have also seen just because of the glove stock. It's one of the good reasons is that people are expecting the share price to follow diligently and disciplinedly just because the earnings potential is going to go up for the coming quarters. And just because of basic mathematics and basic assumption, but never asking that what if PE contraction would happen, actually put a lot of people into this debt trap. We have also some of our viewers coming to us and asking us, they are actually stuck with glove stocks bought at a high price, and what should they do, right? These are the kinds of, I would say, mistakes and also learning process that you have to really understand, because at the end of the day, share prices are the actions of human beings like you and me. Sometimes it can deviate from the company's earnings potential, and it will be very, very dangerous to expect a share price to always follow the PE ratio diligently, because the earnings is going to go by 30%, hence the PE or the share price also has to go by 30%. If that's the case, your share price will not go up and down. It will always become a staircase. Flat earnings growth by 30%, then the share price goes up by 30%, and then it will always trade flatly again until whatever reasons to impact the share price. It will always impact the share price, but it will always happens in an erratic manner. Up, down, suddenly goes up higher, suddenly comes down lower. So do not expect the share price to adhere to the PE diligently. And if you calculate too much based on that, and you never really put in any thought to it, then you're actually committing one of the errors or mistakes that Charlie Munger used to actually say out before. So don't calculate too much, and after you calculate, you don't actually put in a little bit of thought to it and think about it, whether are you actually playing a mathematic game, or are you really actually investing your money? Right. So this is actually a conversation between me and my mom. So my mom asked me back in December, Top Glove and Hatalega, is it possible to buy? And my answer to her is very straightforward. If you plan to hold glove stocks for 20 years, then go ahead. In within 20 years, these companies, as of current conditions and scenario, are still going to become very, very good companies for long-term investment. But I also added another reply on top of that. If it's just less than 6 months, then really it's up to your own judgment. What I see and what I look at investments is that I really cannot anticipate the short-term movement price of a company. Let's say, for example, tomorrow Top Glove will go up, go down. I will tell you honestly from the bottom of my heart, I don't know, because there are a lot of uncertainties coming to play. COVID cases are surging, but there's also a mass vaccination happening in our public. So it can go either way. So my answer would typically be it will go up, go down, or even go sideways. But if you actually want to invest in these companies for 20 years down the road, then it's a very safe kind of company, because from the numbers, fundamental wise, it has actually proven to grow very, very well. And of course, the business model is a very consumable kind of business. Once you finish using a glove, you throw it away and you have to buy a new one and you have to use the new one. So there's always the need of buying new gloves from either Top Glove or Hatalega. So the point is, if you have a longer and more patient time frame to hold on to a stock, then there is really less what ifs that you need to answer. So if you plan to hold on to the company for 20 years, straightforward, these two companies are very good companies, right? Of course, the valuation, everyone have their own opinion. It's expensive, it's cheap. But in 20 years' time, if human population continues to grow, there'll be more emphasis on healthcare and also healthy standard practices, then of course, straightforward, the need for gloves also will increase. And from that kind of assumption, very, very safe, even though tomorrow Top Glove price might go down for 5%, but if you are very convinced to invest in this company for 20 years, what is tomorrow's share price compared to Top Glove share price 20 years down the road? So this is the kind of thinking that you should have, whether you want to buy to short term or buy for a long term kind of investment. So this was actually what I replied my mother, and hopefully, yeah, it still stays very, very relevant. In December, I never really know what could happen, and fast forward to today, the share price actually was so much lower compared to what it was in December. Right. So you might be saying to me, Jupan, you are very critical and very anti glove stocks because you always talk bad about them. You never really appreciate the so-called positive strengths of this company. Okay, so I come back now with this slide. Just now I was always talking about the risks and the factors that you should take note of. But what if I am very sure I would want to invest in Top Glove or Hatalega for 20 years? How would I answer the risk factors that I highlighted just now? So, of course, I will be very honest. If someone asks me, is this going to be a permanent pandemic demand? I will say that no, it's not going to be a permanent pandemic-driven demand, because pandemic comes and go. But I'm very certain for the next 20 years, human population will increase, and there will be more and more emphasis on healthy practices and safe, healthy guidelines as well. And that means that more and more people are going to use gloves, and gloves are going to be, become more and more important as we become more safety orientated against future kind of pandemic. So because of that, down the road 20 years, volume will definitely go up. Will there be a higher permanent, higher average selling price? I would say no as well, because when things normalize, Top Glove and Hatalega have to sell cheap, because there are also other glove makers out there, and they cannot stay at the high selling price because they will lose out their market share. But at the end of the day, if the company can grow on top of volume, just like it always have been, glove prices have never gone up crazily compared to 20, 30 years down before. It has always stayed at a very affordable price range. That's why even though the selling price haven't really go up a lot, but Top Glove, Harta Lega, and the other growth companies have continued to grow their earnings and their revenue as well. So I don't need a permanent pandemic-driven demand. I also don't need a permanent higher average selling price because I have a longer time horizon in investing in a growth company, right? So of course, the favorable foreign exchange rate also will not come to play. Sometimes it will help Top Glove or Harta Lega. Sometimes it doesn't help, but within a 20-year growth horizon, all of this will be negligible and doesn't really play a bigger role. But the bigger role comes from the expansion plan of these growth companies. Of course, same goes to the raw material prices. It will play into certain kind of up and down sentiments for each quarter. But in a 20-year horizon, what Top Glove can grow is not because of all these permanent added factors, but how would they actually grow by having new plants, installing more lines, having bigger capacity. That actually plays a bigger role into ensuring Top Glove grow at a faster and higher rate. And last but not least, this is a kind of risk that maybe you are not able to justify. There will be always other countries that can invest in their own manufacturing for gloves. So this is the only risk that I cannot answer if I am someone who is going to invest into a glove company listed in the Malaysia Stock Exchange. So out of these 5 risk factors, I actually managed to counter 4 of them, and only one is one of the risks I would say is unmanageable, and this is the kind of risk that I'm taking when I invest into a glove company in Malaysia. So coming back to why I still wouldn't invest into growth stocks. So I also realized this when actually I thought through my process. I always thought that I wouldn't want to invest in the growth stock, even though it were to come down in share price. So I actually gave some thought to it why I didn't and wouldn't want to invest into a growth stock. So I asked myself this question: what if I had a chance to go back in time, bought a growth stock, knowing that it will definitely go up because the pandemic is coming? But the caveat is that I will not know when the share price will get sold down as it is today. Will I still buy into this company? And if I'm someone who actually believes in a company that can still grow in the future, and the pandemic comes and actually inflated the share price, would I actually sell the company? So if I won't choose to sell the company, what would my heart feel if I bought Top Glove, say for example, pre-split, or Harta Lega pre-split at less than $1 or 1 ringgit? It goes up as high as 20 ringgit and then comes down back to 10 ringgit. What would be my emotions be? If my emotions cannot take it, or I will feel very, very unsatisfied because I didn't sold Harta Lega at the top price of 20 ringgit, that means that if this were to happen in the future, I don't think my emotions would get the better of me. And due to that reasons, I won't choose to actually invest in growth stocks, even if the whole thing were to repeat again, because I will never know when is it to sell at a higher price, and chances are when it comes down, my emotions will not be able to accept it. So due to this reason, after going through my thought process, I think most likely I will not actually choose to invest in a growth company. But that's just my point of view. I don't know what about you, Junbing. If I were to ask you the same question, I bring you back to 1 year ago, and I say that, Junbing, now pandemic is going to make the glove prices go up. 1 year ago, say for example 5 ringgit, go up to 20 ringgit. Or I will tell you go up. I will not tell you how high it will go, but I also will not tell you when it will come crashing down to 10 ringgit. Will you actually buy a glove stock if you already know that it will go up, but I don't know when it will come down?
I think for me personally, I will buy, but then maybe I won't be the one that making announcement saying I make a lot of money. Maybe my target price is just 10 to 20%. Then I will just sell it.
Yep.
So I will still be interested to ride into those waves, to be honest. If I ever have the chance to monitor the share price or whatnot. But I will be slightly or maybe you call it quite conservative. Meaning when I buy it, I set my target price to sell already. I just put it there. I leave it until I mean there's one setting called good till cancel. So I just leave it there. So when it happened lah. When it didn't happen, maybe I make a wrong judgment, then it's a price I need to pay. So I
Yep.
cannot blame anyone lah. So just something to share lah. It's like Bitcoin very speculative. So lately I started this thing myself. I think not advocating whether it's right or wrong. It's just something that I try to experience because I wanted to explore some of the trading platform as well. So I just put in when it dropped. I just set the rules on my own. When it dropped more than 10%, I will buy, and then I set a target price of going up about 10%, automatically sell. So guess what? I think few 1 week back it dropped to about 48k USD, right? But the time I put a command there, I think I buy about 50k, then gone case. So it's the same strategy that I put in there. Then I put my selling price 55k. Then I sold it yesterday. So this kind of thing is one off gain, but it might hit you. Let's say one day this whole thing become a scam, and it drop. Then you need to be ready to pay for it, because this is not something that you investing because you truly believe on the model, but you just wanted to ride on the wave. So for me, I put in very little money, just to try out this thing. I mean, might as well try out some new platform, because I'm personally quite interested into blockchain. But then whether this Bitcoin is that valuable or not, I have a lot of question marks, because it's not efficient at all. It cannot replace any currency. So I'll continue to do this lah, because I mean 10% based on the volatility has been happening for the past 1 to 2 years.
Yep.
10% is quite safe. If you are greedy, then maybe you can set 15 or 20. But bear in mind, it might one day it go down, can go down by half or even more than that lah. So you just remember, this is something you are ready to lose the money lah. So this is something to share. But on the other hand, for stock market, usually I will go for those that is quite consistent or easier to predict. Take one example. I think Scientex is one of the very good example. QL as well. A company that doing about the same growth rate for at least 5 to 10 years. And it's about the same one. I don't know how they do it, but it's very amazing. So this thing give you a lot of certainty when you invest into it. I mean, talking purely about the PE, for example.
Yep.
So PE can be fluctuating within a year for new company or those speculative company. But for those stable company, it won't fluctuate one. But then you still have capital gain or dividend gain, because the share price follow their earning, and then when the earning is good, then it go up.
Yep.
So the PE remain the same. So it's a boring company, just PE 8 or 9. But then the share price slowly go up, steady, very happy. Then you make your money stable, slow and steady. But then you don't need to worry, suddenly it will just gone like that lah. So I put my majority of my saving or whatnot into this kind of investment. Bitcoin, those is just for fun lah. So it's just like as good as I go to Genting and try out something. It's just for fun and trying out some of the platform lah. But just something to share lah. So back to Japan question, I will buy, but maybe I just make 10%, 15%. I will just sow it, and
Yep.
I won't buy it again.
Yeah. At least you need to have a game plan. So I know that personally, I'm not someone who want to do trading. I don't want it to disrupt with my investor mentality. So for me, I will not do it. So coming back to another company we covered in the EV ecosystem, which is Tesla. So I would just bring you guys through. This is the so-called vehicle delivery numbers of Tesla. So every year you can see that they have been growing very vigorously. So around 100+%. So as of the latest fiscal year 2020 versus 2019, because of more and more factories coming up, So a lot of gigafactories are going to start operating soon. So you can see that the growth rate actually is amazing, 36%. On top of previous year, and the previous year was around 48% compared to the previous year. So looks very good, right? So as we also know that EV vehicles are the upcoming trends in our lives. There will be more emphasis and more initiatives for us to own an electric vehicles because of carbon, zero carbon emission reasonings and also whatnot. But if you were to look at the latest European Union car sales, just purely based on EV, you will notice a little bit of worrying trend right there. Tesla actually slipped behind the line in terms of the growth rate. You have competitors like Volkswagen, Renault, Nissan, Mitsubishi, Hyundai, and the PSA Group actually registering growth versus 2019, whereas Tesla is actually experiencing some kind of compression in terms of growth there. So you experience 11% of growth in your key European segment region. So that's something quite worrisome for me after I went through Tesla's results and also the figures. So even though, yeah, it looks very, very nice here, but do take note that there are challenges and competitors in the EV scene for Tesla. And this is actually showing now in the European Union. Right. So if that was your answer or your questions to the growth momentum of Tesla, then you'll be more protective and more receptive to the fact that it's not going to be the only EV in the world. There will be multiple EV brands in the future. And what if Tesla actually loses out the market share leader position in Europe, right? So this is the kind of questions you need to ask yourself, even though it may seem that a lot of people around you or even a lot of financial content creators have been harping around Tesla. Right? These are the kind of questions you need to ask yourself when you study a company. And of course, there are times that you cannot really answer a question. What if? So will Tesla actually lose out their market leader position in Europe? So that is a question right now. Honestly, I can answer from the deepest from my heart. I do not know. It can happen anyway. Tesla can actually take back market share, or it can continue to lose market share to Volkswagen. So what if you cannot answer such a tough question? So very simple. You actually put the company into your watch list, continue to read news, follow up with the progress of the company. If it's not the right time now, you're skeptical now, do not worry. Wait for the next quarter results to come out with more data and more numbers. You are actually more confident to put in your money. In fact, you're more confident to put in more money if things are turning out the right way for you, for your view in Tesla, or it can actually save you from getting burned because the next quarter would be showing more weaknesses of Tesla in the European Union market. So put it in the watch list. There's nothing wrong. Wait for a right time, a better time when you're more confident. Or if you're someone who really, really has a bit of the FOMO kind of mentality, means you cannot really miss out on a good trend, then I suggest you to just buy a bit and monitor further. At least there's something on your hand, keep you preoccupied before you actually make a bigger buying or bigger position when things turn out to be okay for Tesla. So to round things up, this is also why KayaPlus, whenever we talk about a company, not so late night show, and whenever we actually go through the business model, there's always an ending part where we talk about the risk of the company. It has always been a key component in our Not So Late Night Show sharing, no matter what kind of company. So you need to always know what are the bad things or the risks that can happen to a company. Every company has risks. Every company has potential downfalls. No company is perfect. And the more you understand about the risk, the more prepared you are into investing into it. And if the risk were to happen, you'll know how to react as well, because all of this has been calculated and planned. And even for Stock Plus 2021, stocks that we are very comfortable and very confident in, that we actually list them out, telling you guys that, okay, these are the 10 stocks that we are very confident of for 2021. Most of it, I have it on hand. Yes, they are not perfect. They also have their risk, but I'll still be very, very confident to buy at today's price or to even top up, because I'm very well aware of the risks and the threats, and I'm sure that the strengths actually outweighs the risk, and the good part of the business model, management actually will cover all of these risks and threats. It's not that it's totally zero threats, but just that the upside and the prospect of the company can actually outwin the potential threats and risks that can pull the company down. So last but not least, I want to end today's sharing session with you guys is to always be active in asking the what if that can help us stay rooted to the reality and truth. So coming back to the actual world, there are things that we choose only to believe in because this is what we are happy to hear, and the so-called numbers, facts that we very happily accept because it is what we want to see and look. Say, for example, if you are an investor in Tesla, and if you are someone who is very biased, you will only want to see that, yeah, delivery numbers is growing. What can go wrong? They are the pioneers. They have been in the market longer than any other EV manufacturers. But the other fact and evidence that they tend to forget is that, well, Volkswagen just actually delivered more EVs in the European Union than Tesla. How are you going to explain that kind of scenario that's happening? That could actually give Tesla a bit of a challenge to grow smoothly in European Union. So these are the facts and evidence that sometimes we tend to ignore because it's not what we want to hear. And the thought of actually having facts to actually eat up our investment returns makes us very biased. So we call this the confirmation bias, and always have a very open mind into accepting the total overall facts and evidence, so that we do not stay trapped within our own beliefs and only accepting to see what we want to hear and what we want to believe. That would make us actually a more well-rounded investor to be prepared for what is actually bad things that can happen to a company. So that's about it.
So I hope you really enjoyed the lesson and the video. Don't forget to click like, subscribe, and also turn on the notification bell button to get notified whenever a new video like this gets posted in the future. Of course, there are other Premium Club services that you might really want to check out, and check it out by subscribing to our Premium Club members, link in the description. See you in the next video. Bye bye.